Welcome to the Virtual CPA Success Show, where we're 100% focused on helping service-based businesses achieve success. Are you a business owner interested in learning how to scale your business? Has your business reached over $1 million in annual revenue? Then this podcast is for you.
All right. Hello, everybody. Welcome to today's podcast. Once again, you have Jamie and Jody here from Summit CPA. And today we are joined by one of our rockstar CFOs, Nicole Carlton. So we're going to deep dive into a topic that we've touched on briefly in the past. So we did do a podcast on kind of how the net income statement breaks down. And during that podcast, we talked about one topic in particular that I think it's important we go into a little bit more detail on, and that's the importance of gross profit. So that's what we're going to talk about today, is really dive into gross profit and how it's calculated and ways you can look at it and why it's so important. So Nicole, we're going to start with you. Why don't you give us a definition of gross profit and how we here at Summit calculate it for our clients?
Hey, Nicole, before you do that, can you tell us a little bit about yourself? How long you've been with Summit and all that kind of good stuff?
Yes. Thank you for letting me join today. I've been with Summit for 4 years now. 4 years and just in a couple weeks, actually, it's going to be 4 years. I am a CFO here and I'm based out of Texas for the time being. And I actually started here at an accountant level and then have kind of worked my way up from there.
So time being, means you're going to move? Does that mean you're going to look for a different job?
No, I will not. I will not be looking for a different job at all. It's not in the plan.
So kind of one of the cool things about working distributed, you can actually move really anywhere you want and still not really miss a beat for the most part. So you're moving to a different state?
We're moving to right outside Omaha, Nebraska, and it's definitely been a little bit of a security blanket, knowing that I don't need to change jobs. So definitely happy with that.
Didn't mean to put you in the hot spot there, but so gross profit. So let's get
to
that.
Yeah, so gross profit is going to be the revenue that you produce less your cost of goods sold, which is what it's supposed to take you to produce that revenue. So it's kind of supposed to move in proportion with your revenue. And I'll leave it at that and get into some of those caveats a little bit later.
So for our listeners, most of our listeners are in the agency realm, which we work with a lot of clients in that realm as well. So give some examples of some of those production costs or those cost of goods sold for our agencies.
Yeah, so the biggest thing for most of our service-based agencies is going to be the cost of their producers. So that's going to be their designers, their developers, sometimes the people that are managing those people to some degree. That's going to be the biggest one. The next one that we see kind of falling into the cost of goods sold category for those agencies is going to be any subscriptions that they use to kind of produce that billable work. And I think those are probably the top two, along with your contractors. That's a huge one that kind of falls in there with the cost of work or the cost of your work being produced.
Yeah, for sure. And I'd kind of like to add to that. I think it'd also be the burden cost of those employees, not just the employee expense by themselves. And again, she's only talking about producer expenses, not the admin or marketing team. But we're also looking at the burden costs. What taxes are the payroll taxes? If you have a stipend for your team, like for instance, we offer a technology stipend. It might be something similar in your organization where $2,000 maybe over the years dedicated to that person, and then maybe an education stipend, because obviously we want to educate our team. We don't want somebody else doing it for us. So we want to make sure that our team doesn't walk away uneducated. So we want to educate the team, making sure that's there. So maybe there's an education stipend. So all those different things that really go into the variables of the employee, the 401k plan, obviously, and health insurance, that sort of thing is obviously included there as well. We feel that that's typically about 1.2% or 1.2 times their revenue. So if you're kind of thinking through it yourself and kind of thinking through your payroll costs and you don't know off the top of your head, you could pretty much take your payroll cost times about 1.2, and that's going to be typically what we're looking at as our production costs. And as Nicole said, contractors, obviously you're gonna slide those in there. Again, we're talking about contractors that are in the production process, and then also talking about any kind of subscription that you might end up using for that. Now, again, we're talking about the service-based industry, right? And so with media companies, it's a little different, right? So with media companies, you start at the sales, the top line, the revenue, which includes all your media spend, and then you subtract out your media spend. And some people call that your adjusted gross income. We call it net revenue. Same thing, same term, just different terminology. And so you would shrink that into your revenue stream, net revenue or AGI. Then you take out your cost of sales, like we talked about right now, and that comes up to that gross profit amount. So there's a couple different variables or a couple different ways to look at it. It comes out to the exact same number. And the importance of that number is that we're taking those numbers and we're calculating all the rest of our percentages off that gross profit, the revenue and the gross profit. So that's going to be key as we go along in the discussion to make sure everybody is on the same page, understands what we're talking about. Again, apples to apples type comparison.
I think it's important the way you define revenue there for the media spend companies, because we are going to talk a lot about gross profit and that gross profit percentage. And if you have those direct media costs in your cost of goods sold, then obviously your gross profit is going to look a little bit worse than what we're talking about here. So I think what you said there is a great distinction, because we want to make sure that people aren't like, oh no, Jody said my gross profit needs to be 50%. Mine's only 20%. What's wrong? And again, so it's a really good distinction there. So hopefully our listeners understood that. And then one other thing that I wanted to point out too is a lot of times when it comes to payroll, is you want to make sure you work with your payroll company. A lot of times payroll companies will bucket your payroll people into different accounts, so you don't have to do all the work yourself. So you can say, okay, these 9 employees are my production employees, these are my admin employees, these are my marketing employees. That way you could have that bucketed to begin with. Now, what we will do occasionally is someone's split. We will split their costs. So if you have an employee that they're a project manager, but they're also really good at sales, so they spend half their time managing projects and they spend half their time in sales, we don't want all of those costs going into cost of goods sold. We want half of those costs going into marketing so we can truly understand it. So that will require a journal entry. But a lot of times the payroll companies will work with you in terms of getting those costs split out when it comes to a per payroll person and benefits as well. So let's dive into, now that we understand the definition. So I mentioned 50%. Jody, do you want to talk a little bit about that 50% and why it's important?
Yeah. So typically we see agencies running right at about 50%. Those that spend more money on their team, you're going to have maybe closer to 45% gross profit, meaning the remainder goes to their team. Those that maybe aren't spending as much to their team, you're going to have the opposite. So, but we're going to find that average at 50%. So what we want to do is we want to ultimately derive or come down to a 20 to 25% net income. And so how do we come up with that? We hit our 50% gross profit. I'd say about 10%, roughly, I'd say 7 to 10% of that's going to go towards marketing and sales and marketing. And that's assuming the salesperson and, that sort of thing's included in there, marketing person, whatever. And then the rest of it's going to be the admin costs. And the admin costs are typically going to be the owners. Unless the owner's heavy in the production, then the owner needs to go up in the production calculation there. If they're heavy in the marketing or heavy in the admin, again, that's going to go in there. But we're going to find out that about 30 to 35% tops is going to actually be the combination of both of those. So you're looking at admin, marketing, and I forgot about a facility course. You're going to have the facility, that's going to be about 3 to 4%. So the combination of all of that should be no greater than 35%. So if you're in gross profit minus 35, your minimum net income should be 15%. So if you're not hitting at least the minimum, then you've got some things to work on. Typically, we find it's not in the sales and marketing, it's not in the admin. Typically, we find out it's in the gross profit.
And that's a great definition there, Jody. And I'd love, Nicole, I'm going to give you a little head time on this, but normally what I like to do is I like to pop quiz our CFOs when they come on here. So I'm going to ask you to talk about some conversations you've had with your clients about gross profit, but I'll give you time to think about that while I explain that a little bit. So what Jody mentioned there is that we split them out. And the reason we split them out and we have those percentages we work on, because it gives us the opportunity to focus our conversations. So if I'm trying to talk about the whole income statement and I'm dissecting every line item, it could be a very complicated conversation. But if I can see that your gross profit's falling behind, then I can have some very specific conversations with you. I can talk about job profit. I can talk about which jobs you're doing well on, which ones you aren't. I can talk about your employees, which ones are producing and which ones aren't. So that really helps us limit our conversation. So now I'm going to throw it over to you, Nicole, if you want to give us some examples of conversations you've had with clients around gross profit and how those conversations have gone.
Yeah, I think the most common conversation we have around gross profit is whether our cost of goods is the right size for the revenue that we're producing. So really it's centered a lot around, is your team size, your producing team size, accurate to do the work that you're getting through revenue, but it's not, too large or too small. A lot of times we get out of sync on our revenue and the size of our producers. So especially like right now, I don't know when this will air, but we're kind of at the tail end or maybe even in the middle of all of the coronavirus things. We are kind of in a period where a lot of people's teams are inflated beyond their revenue. And there's times like now where it's just something that we weather through. And then there's times where your team is really built wrong and it's not built for the size of business that you are, and we need to right size. And sometimes it's to the positive. Sometimes you have way too much work and you need to rapidly scale up. But that's in our kind of day to day, that's the most common conversation we have around the gross profit.
Yeah, that's a great example. And just to give people a great example here is like the math is pretty simple when you're talking about gross profit. So if you know your cost of goods sold are 2 million and you know your gross profit needs to be 50%, you can easily back into what your revenue should be. If your cost of goods sold is 2 million, divide by 50% or multiply by 2, your revenue should be around 4 million. If you typically operate around 3 million, your cost of goods sold is just too heavy. So you need to do one of two things. You need to let people go or find a way to become that $4 million company that you want. So that's a great example. Joe, do you have any other examples you have there as well?
Yeah, I think that's the big discussion, right? So when we meet with our clients weekly, at least one of those meetings, we're talking about the forecast. We're looking forward, and again, it's a forward-looking concept. So we're looking over the next, 6, 7, 8 months, 3 months, whatever that concept, whatever that time frame is. And we're always looking at, do we have enough revenue to support our team? And like Nicole said, is our team built for the revenue that we want to achieve? So we may be in a growing stage, and maybe today we don't have the revenue, but we know we're going to have it tomorrow or next month or whatever because we got this big contract that's going to be signed. And so it's one of those deals that it's not a like, oh no, today we aren't hitting our number, we need to let people go. It's not one of those type of deals. It's one of those deals that we kind of have to look forward and say, hey, based on what's going to happen over the next few months and based on having these 5 things, fall in place for us, we should have enough revenue to be able to support our team. And then it becomes the fact if we don't, it's a normal thing where maybe we are staffed too much. Maybe we look at our contractors and say, hey, can we get some short-term contractors in here to kind of fill in some gaps for us so we don't have to have that long-term employee that we're going to have to eat a lot of their bench time for when it comes time to or in slow time. So again, I think it's always a forward-looking thing for us. And any conversation with a client, they look forward to that conversation because this is where they really get excited about where's our company headed. What's our company looking like next year? Not just on the revenue side, but what's cash looking like? We're going to be in a situation with the bond line of credit in 3 months. I'd rather know now than know, 3 months from now when I can't get a bank loan, because, the financials are looking really bad, because we lost a big client or whatever. And so it's important to get that, have that forward looking thing all the time. And gross profit is the key to that for sure. 99% of the time when you're not hitting your bottom line is because it's in your gross profit.
Yeah, definitely. And I think that this is oftentimes one of the first conversations we have with our clients, just because everybody's coming in and they're talking about revenue and they're talking about how big of the company they are. But I think defining how big of a company you need to be is important because it helps you take those next steps. So I think it's definitely one of the first conversations that we have. And after listening to this podcast, it wouldn't be too hard to go back to your books and maybe do some allocations and look at it and figure out like how big should my company be based on the cost of goods sold. And then the fun part comes. Then the part comes trying to make those decisions to right size your company. That's where the real work comes in. But getting the question is the first thing, and that question comes from those numbers that we're talking about.
Yeah, and I'd also caution you, if we're saying, hey, 50% is the gross profit you need, but you know what? If your bottom line you're getting 25%, that's cool. I wouldn't change a thing up the top there. If I'm getting 25%, my gross profits, only 40% or whatever, that means that you're really lean on the admin and marketing side. And there's nothing wrong with that either. So don't go back and say black and white, hey, Jamie told you, because it wasn't me. It was Jamie told you that it was going to be 50% or you're in trouble. Look at that bottom line also. And if that bottom line is where it's an acceptable amount, then your gross profit's acceptable. Because I've had many clients that they're like, you know what, we're going to pay our people more than everyone else. So our gross profit's going to be 45%. We're going to live with that. We're cool with that. And if they're cool with that, and that's perfectly fine, then, it is what it is. Let everything flow to the bottom. And now that you're going to be, generating maybe a 20% net income based on how things are going. If you're okay with that, then I'm okay with that. And so again, it's not a black and white thing necessarily. So keep that in mind when you're looking at it. Look at the culture of your team and so forth. But if it's way out of whack and your gross profit's very, very dinky with a service-based company, then you definitely have to do some right sizing for sure.
Yeah, and I think that it's just important to know it. If you know that you are a low gross profit company, but you don't have a lot of sales needed because you're working off of referrals or with current companies, I think it's good for you to have that in mind so that when the next thing changes in your business, you've automatically got kind of some parameters around, okay, this is what I need to do because this just happened.
Yeah, I always like to think of it as buckets. You kind of have the four buckets that Jody talked to. You have your cost of goods sold, you have your marketing, you have your admin, and you have your facility. And if your cost of goods sold bucket's going to be super large, then you're going to have to decrease the size of one of your other buckets. That's fine. Like every business runs differently, but the big thing is you want to make sure at least that bottom line 15% is correct. Because if you aren't making at least 15%, we talk about 10% being the new break even, but 15% gives you the opportunity to grow, gives you the opportunity to do those fun things that all business people want to do. There's very few business people that get into the business just because they want to always run $1 million company and make no changes. A lot of people come into it because they want to try new things. They want to, hire more people. They just met someone on the street they think is going to be a great salesperson. We want to make sure we have the ability to make those hires as you grow. And you can't do that if you're just pulling in 8% each year, and you won't have the opportunity to do that.
For sure.
So I'm just going to take a quick second to throw our email address out there. So we use this email address. We've actually started to get a lot more traction in here. So we appreciate people reaching out to us. We want to make sure that our listeners are telling us what we should talk about. We're always looking for new topics. We're looking for new guests. We're hopefully the next couple of weeks here going to bring some clients on here to kind of talk about how our how our services actually work. So we'd love to hear from you. We'd love to hear from the listeners on what they want to hear. So the email address is vcfo@summitcpa.net. Again, vcfo@summitcpa.net. So that's the email address. So appreciate anyone reaching out to us. One more question for you, Nicole. We talked a little bit about contractors. Can you kind of talk about the different decisions people make and some of your clients have made in terms of hiring a contractor versus an employee and the kind of things we need to think about? Because obviously both of those go into gross profit, and there's different thoughts you need to have in terms of both of those going down either one of those paths.
Yeah, the times that I see contractors come in are when you've got a project going on and your team is just a little bit short in capacity. So we need somebody for the duration of this project, but maybe not indefinitely. Or, we think we're going to get there, but we would feel more comfortable without a strong commitment. A lot of our clients care pretty deeply about not bringing someone on and then letting them go 3 months later when a project ends. So that's kind of scenario one. You've got a short-term increase where you need the capacity. The other time is when you don't quite have the right seats inside your business. So maybe all your designers are full, but you need a designer for a short period of time, or, vice versa. You need a developer for a short period of time. That's the other time where you either just don't have the right seats as far as you don't have that specific skill and you don't normally do it, or all of your people with those skills are just full for the time being. Those are probably the two biggest instances where I see it.
Especially on the production side, and I think it's great with the two examples you gave. And I think the one other thing that I've seen done somewhat successfully recently is the contract to hire path. If you think you're about 6 months away from hiring a new employee, maybe you start now and see if you can find someone who can come in and try it out, whether it's someone who's just coming out of college or whether it's someone who's been a contractor for a while who might be looking for that full-time work. I've had a company that's been pretty successful with their last 6 or 7 hires, having them be a contractor for 3 to 6 months, really try them out and make sure that our company is a good fit for you, and also make sure that you're a good fit for us. And so that's worked pretty well for one of my companies, but it's hard to time it right. That's where it gets tricky. And then oftentimes, contractors are often more expensive depending on the type of contract you hire. If you're going to hire someone for a 3-month project, you might have to pay $100 an hour. When you bring them on as a salaried person, they're only going to be 50 to 60. So that's where it gets a little challenging sometimes. There is that, because you have that safety of they're only here for 3 months, you do have to pay a little bit more for that.
And I'd also be careful, know your state laws too. For instance, California has some contractor laws out there. You just want to make sure you're aware of it so you don't get yourself into an unintended tax situation. Sure. By going that route. But I completely agree. Contractors are awesome to use to fill in the gaps. And I see it especially, as Nicole had mentioned, that you may have enough people for the job, but you may not have the right people for the job. And that's where the contractor with a specialty might be able to come in and help things out. And so hugely used and definitely a good concept to keep in your tool bag.
I know we've covered quite a bit here, and I think it's all been really good information. Any final thoughts, Jody? Any areas we missed on that we should make sure our listeners understand when it comes to the gross profit area?
Yeah, I'm so in tune with the gross profit. I mean, gross profit's what I look at that's like the number one thing I look at every single month when I close it out. Where's our gross profit at? Where's it at now? And where's it going to be at going forward? I look at that more so than I do my net income, because my net income, for the most part, and I think with any company, is pretty fixed. It's pretty steady there. We know we've got a pretty good grasp on marketing expenses. We've got a pretty good grasp on the admin. Owners don't usually randomly pull money out, so it's pretty steady there too. So everything there is pretty grasp on. I'm constantly looking at that, and so much so that we've developed our profit sharing plan based on that. It's like for our CFOs, if they maintain gross profit of a certain percentage. Again, it's never going to be that 50%, because when you look at the profit per employee or profit per client, you're always going to look at a higher percentage, around 75, or I'd say 60 to 75% is where you want to main per company, because you always have that downtime, the time that you can't bill clients and so forth. That's still stuck in your gross profit there. So we always look at that, and we incentivize our team, our CFOs, our accounting team, our auditing team, all the different branches of our team. We try to incentivize it based on the gross profit, because that's how important the gross profit is. Because we know that if we hit that 50% gross profit and maintain it there, then the sky, everything's going to naturally go down to the bottom line. We're naturally going to have the cash, and we're naturally going to build things up to have fun time to do fun stuff like go on team retreats and that sort of thing. So we know that's going to happen if we maintain that gross profit. And so if I were to incentivize people, I would say take a close look at incentivizing based on gross profit versus net income. It can be dangerous. Maybe if your admin and your marketing fluctuates dramatically, that could change a lot. But for most companies out here listening, I don't think that's the case. And if that's not the case, then I would definitely take a look at that for sure.
And what I've noticed at Summit, and I think I've noticed this with clients as well, is when you make the incentives at that gross profit level, and as a company culture, we just talk about gross profit a lot. A lot of times, the people who are doing the work are the ones who are going to help you find those efficiencies. So since we've moved our gross profit as our incentive, we've had some awesome conversations as a team where our CFOs have brought up ideas, our accountants have brought up ideas, because they're the ones doing the work day to day. So they're really going to understand those improvements. It's really hard for Jody just to sit back and think about, how can I improve our gross profit? I'm sure he has a lot of great ideas, but if Nicole's in the front line and she sees something, she's like, this one area is killing every one of my jobs. Is there a way we can fix it? And she might not have the solution, but at least she's bringing up what is causing the problems. And I think that's the great thing about focusing on an area like gross profit, is if you get that fixed, to Jody's point, everything else is just going to get improved. And so I think that's it's really helped us as an organization. Wouldn't you agree, Nicole?
Yeah, I think that kind of putting the gross profit in front of us and empowering us to kind of tweak things in our own workflow that affects that is really a huge driver. I mean, it's totally different than saying we're going to incentivize you off of net income, which has, all these costs that really you can't impact. I mean, the gross profit we can work on day in and day out at every level of the business just through tweaking our own processes. So I think it's been a really big game changer, especially in like the mentality of how we look at our work and how we take ownership for our work.
Especially when you have an owner that loves to take retreats, and it's like every time you take a retreat, everybody's like, "Oh, there goes our net income goal." Yeah, Jody's going to the bar again.
Hey. No, when it does come down to it, I mean, there's things that people can control to make that gross profit better. And there's three things. You got your people, obviously. Tools, are you using the right tools to get you to that gross profit? Tools, I mean, like software and that sort of thing. And then the processes. So are your processes designed to get to that gross profit? So if you're not there, it's going to be one of those three areas. It's going to be the people. Do I have the right people in place? Do I have the right tools to get there? And processes. Do I have the right processes in place in order to generate that profit margin? So those are the three different areas you need to look at if you're not getting that gross profit. And again, incentivizing the team around that, I think, really helps define that and helps pull those things out pretty naturally, because you'll start hearing about it. Hey, this tool I'm using, everyone's using, it's garbage. Can you find something better? I could definitely get this done quicker if I had that tool to use or whatever. And then it gives our team a chance to actually correct that. Whereas if we're not really focused on it, maybe we use that tool forever and we always have that bad flag time there between when it gets done. And people just put up with it. But I think if you make that incentive around it, I think it really kind of helps everybody kind of get on the same team. Not incentives don't like. everybody's incentivized by different things. So money's maybe not be the only way to incentivize. So maybe it's not a gross profit on money. Maybe it's a gross profit on, hey, we do X, Y, Z if we can get this done. Or maybe it's, other things, like the team retreats at a different place. There's a lot of things that motivate people. And so you kind of have to figure out what motivates your team. But whatever that motivation factor is, I would send it around that gross profit.
I also think, just to expand on that a little bit more, something else that I feel like we've done that's been super helpful is not only do we talk gross profit, we talk other incentives that help you hit that gross profit. So for us, it's obviously the amount of clients you handle. So if as a CFO, you can handle one more client, that's going to be very helpful. What kind of changes do I need to make, Nicole, to give you another client? And that's the type of conversations we have. And I think with our design and dev shops, you can say, hey, I need you to finish this type of project in 5 weeks, and it normally takes 7 weeks. What's it going to take to cut a week or two off that project? And that kind of spurs those right conversations. Instead of just talking about dollars and cents, you're talking about time, you're talking about efficiencies, you're talking about tools, because we're not just focusing on the dollar amount. We're focusing on real day-to-day decisions that I have to make as a CFO. Is, okay, if I needed to add one more client, what I would really need is this. And then we could have those conversations. Or if I needed to cut a week off a project, I really need this. And then you can kind of have those conversations and just try to figure out what it takes to do that. So I think not just focusing on the dollar amount, but focusing on some other numbers are super helpful.
Sure.
Great. Nicole, any other areas of gross profit we missed?
I'll remember them when we get off of here.
So, Nicole's asking for a second podcast, I think. She wants to join us again. Awesome. Well, no, I appreciate both of you guys' time, and I think this is a great topic. And as always, our listeners, feel free to reach out to us. And thanks for listening.
Enjoy this episode? Visit our website at summitcpa.net to get more tips and strategies for achieving virtual CPA success. We're here to be a resource in this ever-changing industry.